Hello guys, and glad to have you on board again. Today we're going to keep on doing those intraday or less than a daily type of chart analysis, and we're going to try keeping those regularly each and every Wednesday if time allows me to do it, with no guarantees throughout the summertime, but of course we'll make that on a regular basis starting by September or some kind. Okay, so despite that, let's get straight into this. The reference time frame right now might be H1 to 4 hour. That's the bracket in which we're going to pull ourselves for those forecasts. We don't look at anything aside these two time frames, which should normally give us a trade or tradable context on a weekly reference basis. So this is what we would do. We should get something to talk about at least once a week. So this week talking about would be, if we look at Ethereum on an H1 reference context, what we have is just a big fucking fat mature range in which we're dealing with the 5th range boundary. The market is headed into contraction, which means that the bottoms are rising, but the resistance are kind of either stagnant or slightly decreasing. So in that perspective, we just have one very boring neutral range kind of context. So the market trades below these contexts in a very short manner, in a very short timed manner. We already have the signals of this market bottoming. It has been a little bit more brutal to the downside yesterday because the signals were there, and this is where I personally have traded yesterday. And in that perspective, it didn't really work out as the market decided to flush out volatility. And guess what? Oh, just to go for the volatility boundary itself, meaning that just the market has turned down intraday volatility just to hit the broader volatility boundary in here. So just like the market wanted to test that level, God knows why. This is, once again, volatility is the broker's way of dealing with prices because they have to be net neutral. So when the market doesn't give a fuck about value, of course, the brokers, well, do what they do best. They arbitrage volatility. So in that perspective, we just went down there. It was possible, but not necessarily required. But still, anyway. So here's an area of support for Ethereum, and I think we definitely will hold on to that boundary. So we'll see all about that. In the meantime, well, this is no more than a big fat mature range, meaning that H1 time frame no longer can be traded. It has to be assessed in the broader perspective of the H4 context. So H1 cannot be traded anymore as the range is mature. Okay, so if you want to keep on trading with this, perform the dumb range trading strategy. Put your fibs and patiently wait for the areas and for the market to try moving violently one way or the other. What I would like to mention, and what I've mentioned already, is the fact that in this big bearish outflow, the thing is that we already have several third range boundaries. The first one being somewhere in here. Very brutal way of thinking, but as we reverse the context, we definitely had a third range boundary out there. There has been a second one in here or in here, God knows where you want to put it, and a third one in here. And the beauty of this is that the three are actually aligned. Here's the third range boundary, sorry. So this is what it is. We have 3 aligned third range boundaries, which is definitely the sign that, boy, if you short that market, you are dumb. So I've always said, and I'll say it again, shorting this market is very dangerous, but buying it doesn't make it any easier. So it's really that same old problem. The bears are out. No one is dumb enough to sell, at least not from the smart money perspective. So no one is going to sell resistances. But the problem is no one is buying through them either. So in that perspective, the market makers do what they do best. They arbitrage volatility. And until that game keeps on playing, or until that game stops, well, we're not going to be able to break any significant levels. I still tend to believe that the bottom is in, but that doesn't mean we're not going to go. That doesn't mean we're not going to go anywhere. We can just stay there. That's one of many options. So we're 5 range boundaries in, and there could very well be 6, 7, 8, or whatever. Okay, as long as we do not have a clear shift in the demand side, prices may stay there. But there is no room to the downside, and I'll say it clearly once again. Those who think we're heading lower are taking serious amounts of risks, and more importantly, if you are trading with this, meaning you're short fucking selling this market, good luck with that. I'm definitely on the other side of that trade. by the way. Out of cryptos, we could have a look at all coins, but I'm going to pass on this. The situation's pretty much the same everywhere. If we have a look at Bitcoin, same old boring range. Here's where I bought the other day, still waiting for this market to break out of this range. Bullish or bearish, don't give a fuck. You know the usual areas and the usual suspect. If we go there, this is where I will stop buying. If we go there, this is where I'll take my profits, pure and simple. If we go for Solana, same old thing, same old range, okay, boring stuff. In here, the reversal pattern's been due to volatility limitations, same old thing, okay. We've gone to the volatility boundary to find a bottom, a local bottom, so we're not yet out of the woods for Solanas, but until further notice, there is not enough price breadth for this market to go lower. So it's in kind of a technical rebound that's maybe happening, but it requires demand to get there. So it mostly depends, I think, on the same old fucking boring story on all of these things. ETH, so whatever, what we're looking at is ETH versus dollar. So the bigger problem here, the big elephant in the room, is the same old story with the dollar, which we're going to talk about afterwards. So if we have a look at indices, on the other hand, the structure in here in terms of S&P 500 still tell us very quickly, okay, go in, that we are dealing with H1 reference context, we're dealing with the trend channel. What I like is the fact that the algorithm in here already detected sine wave as a breakout, leading me to believe that, well, either the indicators are 100% wrong, or we're going to buy the bottom area of that chart, meaning below 50% context is going to be bought with the trend channel. And in that perspective, the next target will be to reach out for the context, the moving averages, and where the trend channel all converge. So this is where I think we're headed for the big fat event, the FOMC meeting. I think everything converged to that 4,000-ish area, but that doesn't mean that it's going to be a game that is won by default. I just think we're going to go back to neutral, back to the moving averages, and we'll see whatever happens. Luckily, we'll have a positive resolution, or worse, we're going to retest the lower time frames, third range boundaries, which will very likely act as a strong support. Anyway, okay, so I think retracing to the resistant context and possibly reversing it to offer a third range boundary opportunity afterwards is what seems to be the likeliest outcome. In order to risk manage your trades, this is H1 time frame reference because you always trade in context, remember that, and the risk limitations are definitely not gorgeous at all. The only thing we have is that the bears are out, and they better have to be. On aside of this, we have a bullish context detection, so we'll see if the market prices those in or not. In order to do this, we need to validate by getting to the trend channel again, which means I personally think that if we pass through this level, we're out of the woods and we're headed into the areas that we've highlighted. Otherwise, well, like I said, the market will just play with the same old game. I think there's no way to break below these levels, but I don't think there is a necessary straight line way up there, despite the fact that we could have a change in the CPI forecast. So if we're kind of exactly at the market expectation, I think we could just stay there, meaning that we'll grind our way up throughout the next few days and headed into the FOMC, but I don't think there is even a chance for us to go back to the third range boundaries. Okay, so I would say the risk limitations in here are not so bad, exit patterns are quite solid, but that doesn't mean this is necessarily an easy trade to take. We still are facing bearish moving averages, which tries to stabilize, so well, buying a moving average is definitely bullish. That means you think the prices are definitely headed out there if you really want to buy out there. In terms of stop losses, I think stop losses must be set below this level, not at this level. So take a necessary safety net. I think that in here, the trend channel size is not enough for this trade to be taken. So if you're really going in, account the fact that you don't have enough risk limitation for now. So either you're waiting for kind of a lower shadow candle or something, or you're actually doubling the stop loss sizing by reducing the position sizing accordingly. On other markets perspective, eventually looking at the WTI, which is trying to stabilize as well. We're trying to bottom in, still facing some very weird flows, but still no third range boundaries in sight. Even though we've gone context to context, the market failed to stabilize a delayed third range boundary. We're back to the bottom. So same old story, nothing too fancy in here. It's a 4-hour reference context to be traded. We're in the bottom of that range. We have detected context, not yet closed. This is current This is the current bar that is highlighted, so we'll see if this one sits in by the close. If it is, then there is an according signal, but these are for reversal context, okay? The dark blue boxes are for reversal context. So a reverse within exhausted momentum, which is momentum overload, well, that's not necessarily a guaranteed bottom. So account for this, that normally the trend channel's width should be more than enough as a risk limitation, but this certainly doesn't allow you to take a 2% risk on these types of trades. I would recommend a maximum 1% if you're willing to buy WTI. Of course, I don't give a fuck about buying WTI, so I'll pass on that trade. US 10-year yields, on this perspective, we're in the big fat middle of the range, still waiting for a potential either third range boundaries, but the demand areas are going to be really easy to forecast. We're really sitting right in between of the two demanded areas. If we go out there, I think there's going to be a nice rejection, possibly as a bearish third range boundary, but most importantly, I think that this is where we could head, and if we're headed that way, then I think there's going to be a nice opportunity to buy. The risk limitation in here was very weak back then, but I think if we're headed to trade below the context and below the moving average, closer to these 2.60% or whatever, I think shorting T-bonds will definitely be a nice trade to take. Trend following these things as being one of the wildest fucking mature range once again. The same old expanding wedge fucking structure, introducing one more times the huge uncertainty there is in these markets. So I'm patiently waiting. If this shows up, I think it's going to be an opportunity. If this shows up, I'm not going to take it, but this is by far, I think, the likeliest outcome. Of course. When it comes to dollar, because we definitely have to talk about this motherfucker, either we study it through EURDollar, which is the current major impactor, or we study it through the eyes of the DXY. Well, if we do it that way, well, 4-hour chart is a big, massive upflow. So in that perspective, wait for this to neutralize. Don't try to play God. Don't try to catch the falling knife or whatever fuck that is. But trees don't grow forever. Remember that. Only the dumb things that this only the dumbs think these things happens forever. Only the smart money knows they don't. So in that perspective, I definitely forecast that a local top might be here, but I'm definitely not risk managed enough to trade it. So I'm not trying to catch the fucking knife, by the way, but I don't think we're going any way further than that. I don't think there is any reversal near, but possibly a forthcoming third range boundary will take interest for me to go for a short trade on a range perspective, though I don't think we're going to reverse nearby, but I think here is where the lower risk trade shows up. So wait for this to happen. Don't try to play God is what I would suggest. In an H1 reference, the outflow is very, very, very mature. So much mature so that I personally think that this doesn't worth trading. As you can see, so many alerts tell you that this is not where things happens, squeezing the momentums whatsoever. So it is a matter of volatility arbitrage in these time frames. And as you can see, the volatility are still the volatility boundaries are still open, so don't try to trade H1 reference time frame. I think 4-hour is where the game is, and it requires, personally, I think, to reverse this market, build a local bottom or top on dollar. We're going excessive, as you can see, so I think we've made an excess by reaching out parity to just headline fucking stuff, but I think we're nearing the end of something. So don't try to fight against it. As we can say, market can remain absolutely dumb and stupid more than you will be solvent, so don't try to play against this game. But in my personal opinion, we have a local top coming with the CPI. I mean, odds are significant in that perspective. Okay, and finally, therefore, we're going to have a quick look at silver. So silver is absolutely not trading either H1 or H4 time frame. As you can see, this is pretty unconventional stuff, so don't try to play God in here as well. This is definitely not an H4 time frame thing. We can see that we're locked between outflows, so 4-hour might be nothing but just absolute big noise, so don't try to play God. If we put the bracket on H4 and H1 time frame, there's definitely not a thing we can do on silver now. So waiting for these things to pull out some context. But in here we have some trending context, so wait for the context to reverse and we'll get a nice third range boundary afterwards. Okay, so be patient on silver. Definitely nothing to forecast this week on these markets. We do notice The exit pattern in here, okay, which is detected by the algorithm as well, and this triangle confirmation pattern. So exit signal says if you're following the fucking flow, you better get the fuck out there. So once again, I don't think silver is strong. I just think dollar is too strong and it's going to weaken. And in that perspective, everything that is against dollar, silver included, will likely rebound and build a local bottom. How long is this bottom going to be is a big question mark. But once again, just like back then, if you're trading when the market says exit, motherfuckers, well, this is not the appropriate time to go with the trend, okay? It's the appropriate time to lock on some partial gains, let the market breathe a bit, and then go back at it. Okay, so stay tuned for further improvements or deteriorations in terms of silver. It really is $1 a day, but lots of factors and technical factors points into the direction the fact that despite a major shift from the forecasts of the CPI, I think we're headed into the inflation peak, meaning that the CPI might be either aligned with the forecasts or lower, and in that perspective, that's probably going to be a good news for the rest of the market as the dollar will stop its fucking bullshit run. Bye guys!